Hello, everyone. So, last class I talked about business cycles and tiptoed just a little bit into finance. Today, I'd like to expand upon that and talk about finance more specifically. So, just to give you an idea of where we're heading, we're going to start by talking about the functions of a financial system, like what it should do ideally, and then how it deviates from that in reality and some of the reasons why. I'm going to talk a little bit about the old financial system, boring old banking that preceded what we have today, and kind of how that differs from the new financial system. And then finally, I'm going to wrap up with a brief history of financial deregulation in the U.S., and that should bring us up to kind of modern day thinking on what the regulations on a financial system are. So, what is the function of a financial system? Ideally, what a financial system should do is it should allot capital to alternative uses. And it should do so in accordance with which investments generate the most benefit to society. So essentially, insofar as we think about markets distributing goods and services, we can think about financial systems as distributing investment to alternative endeavors. The mechanisms by which this takes place are through banks extending credit to individuals or firms. It could occur through firms issuing bonds or stock. This could also happen where governments issue bonds. And finally, kind of sitting over top this whole system are systems of insurance that help kind of firms and banks and individuals deal with some of the risks of investment, the uncertainty inherent with it. So, but always remember, in social terms, the functions of all of those activities should be to support investment in the quote-unquote real economy, to generate goods and services that people want to purchase, or in the instance of government bonds, to generate public investment in public services and goods that people want. So, having all this in mind, does the financial system really live up to doing this? Well, maybe in some cases, maybe not in others. The old thinking was something called the efficient market hypothesis, which in a way is kind of assuming that all asset prices are correct in the sense that they are reflective of the underlying values of the assets. So if I owned, say, 1/1000th of Apple, the efficient market hypothesis would say that my 1/1000th ownership of it would be reflective of that firm's intellectual property, their physical capital, and all those things that make up the value of a firm. And so all of the information that's out there is kind of condensed into the price of a share. Implication of the efficient market hypothesis is that it's impossible to beat the market. So in essence, it's impossible to do better than the market because market prices are already reflective of underlying asset values. This clearly doesn't hold in some cases. Investors regularly over or undervalue different pieces of information, and investor behavior can also be very herd-like. And there are some very important reasons why investor behavior may appear herd-like. So let's talk about Keynes and his thinking on this, which actually relates very nicely to more modern thinking on behavioral finance, which is kind of like the cutting-edge discipline that's looking into this. So Keynes believed that there were two types of investors. There were these investors that invest based on long-term profitability, and there were other investors that were investing based on short-term fluctuations in price. So the long-term investors were going to basically say, I think that this firm is going to be very profitable in the future, so I will give my money to them so they can engage in capital investment, and that value of that firm will appreciate over time. Short-term investors or speculators are more focused on the short-term fluctuations in the market. And so they hope that they will be able to simply sell their share of a company, for instance, for more than they paid for it weeks or months after they did it, rather than holding on to it for years at a time. Speculative or long-term finance may be dominant in any given financial market at any given time. But because there's this kind of feedback effects going on, it's said to be something called a beauty contest. This is the example that Keynes used. It's based on this newspaper contest that was really common back in Keynes's day in Great Britain, where they would basically put a bunch of pictures of women in a newspaper, and then people would write in to vote on not who they thought was the prettiest, but they would vote based on who they thought the average person thought was the prettiest, and so in the same way, there's a similar sort of thing going on with different financial assets. So if a given financial asset is thought by most other people to be highly profitable, that will herd people towards it. So, and similarly, if people think that a given asset is kind of a stinker, that it's not going to be profitable, then people will flee from it. And so this way you're kind of not only investing based on the qualities of the assets themselves, but also the perception of value of those assets of all the other people that are also trading in the same market. So this is one way to kind of formalize that herding behavior. So on this graph, I've got two axes. I've got a payoff, so just higher is a higher payoff. And the horizontal axis is the number of people engaging in speculative finance. So basically the number of people choosing strategy S. The alternative strategy is the people engaging in long-term finance, which is L. In this simplified model, I've chosen to keep the payoff to long-term investment fixed. We could model that more complexly. And then I've also got the short-term payoff, or the payoff to short-term investment upward sloping. So the more people that are engaging in speculative finance, the more relatively preferable speculative finance becomes. And so if you are to the left-hand side, so there's very few people engaging in short-term investment or speculative finance strategies, long-term investment is the most profitable strategy. But if a certain number of people goes beyond the threshold where those two lines intersect, then this dominant strategy becomes investing based on short-term fluctuations in price and not long-term profitability. So this is one way that it can be simply modeled, so with this changeover point. And so if you kind of tilt one way or the other, that rapidly changes the strategy that is most beneficial. And ideally, socially, we want investors investing based on long-term profitability rather than a short-term fluctuation. It is important to remember that that if the efficient market hypothesis were true, then the returns to both short-term and long-term investment would be equal because prices would be correct. So this behavioral finance approach depends upon the efficient market hypothesis not holding, which it seems to not hold in reality. It's a kind of nice theoretical construct that doesn't really bear out in practice. So, changing gears, let's talk about kind of the old financial system. And we'll start with commercial banks because they're kind of the oldest and simplest of these institutions. Commercial banks historically have done very little. They just took in deposits and they extended credit. So they kept deposits and they made loans. All of this is through some sort of confidence trick, as I believe Chang calls it, because banks make promises they cannot keep. They do not have enough physical reserves of cash and other assets on hand to pay off all of their depositors. They do have assets greater than their liabilities, but they may not have enough liquid assets on hand to hand that out to everyone who, if everyone were to come to the bank to withdraw money at the same time. And so this is, without this like confidence trick, this banks would not be able to make money. So with this trick, they're able to make loans. A bank, be it commercial or otherwise, may face two major challenges. One is insolvency, the more serious problem. And insolvency simply means that they have liabilities greater than their assets. So if everybody came to the bank and was willing to wait as long as they wanted to withdraw their money, the bank would still not be good for it. Illiquidity is a less serious problem, but it can still sink a bank absent some other policies that have been put into place. Illiquidity simply states that a bank is illiquid if it doesn't have enough cash on hand to pay its depositors or other liquid assets that depositors would accept. So this illiquidity problem is exacerbated if more and more people come for their deposits all at the same time. You know, the classic bank run scenario. Another important concept to keep in mind in the background of all of this is that asset values are not fixed. So if a bank holds an asset, let's call it a mortgage-backed security, that asset value fluctuates at the market rate. And so if a bunch of banks are facing liquidity constraints all at the same time, they may all attempt to sell off their assets at the same time. This increases the supply of that asset in the market, which reduces its value. And so in that way, a bank that's facing illiquidity that has to sell off some illiquid assets could face insolvency because the value of the assets they hold may continue to fall. And so in this way, it's important to think about banking as a system and not as individual banks, because banks are really linked together in this way I mentioned, in that they may hold a lot of the same types of assets, but they also tend to borrow and lend to each other a lot. And so because of this interconnection, you know, suspicions about one bank's liquidity or solvency can easily spread to another bank. And importantly, this can also spread to other sectors of the economy because banks have long-running relationships with firms. Some policies that have been put into place to help deal with this are things like depositors insurance, required reserve ratios or other regulatory ratios, and finally good old regulation. So let's take each of those in turn. Depositors insurance is really trying to deal with liquidity and preventing of bank runs. So in the US, there's a program called the FDIC, the Federal Depositors Insurance. Forget what the C stands for. But anyway, the FDIC. And essentially the FDIC says, hey, even if your bank fails, we'll pay you an equivalent value of your deposits up to some certain capped number. And that cap is usually quite high. I believe it was $250,000 and it was upped relatively recently to even higher. So in this way, if people think their bank is insolvent, they don't have to rush out to withdraw their money because they know that those deposits are guaranteed by the FDIC. And in this way, it prevents bank runs, and banks were less likely to face liquidity concerns as a result. Another policy was put into place are required reserve ratios. So essentially saying, okay, bank, you have, let's say $1 million in liabilities, then you have to have 10% of that in asset, or you have to have 10% of that in cash on hand. So this way, by kind of tweaking that, you can essentially regulate the cushion of liquidity that a bank must keep around. And finally, regulators may prohibit banks from engaging in certain types of investments. So it may not allow banks to hold especially risky sorts of investments. And so all of these things are kind of what we can think of as like the first line of defense of regulation to kind of keep the crisis from happening and to keep banks from failing. Now, if the banks do go on to fail, there is the possibility of a bailout, which is where the Fed or the Treasury will simply provide large loans or grants to these institutions to keep the doors open. This happened a lot in the wake of the '08 recession because many institutions were systemically important. So if they failed, it would further hamper the financial system and the real economy as a result. But bailouts have their own issues in that if financial firms or even normal firms expect a bailout to happen if they get into trouble, they may engage in riskier behavior that yields a higher rate of return than they otherwise would have. This is called moral hazard. So that's something also to keep in mind, where regulators want to really avoid a commitment to bailouts because then that will make the system less stable in response. So I think I already talked about this briefly, but different ways that financial investment occurs. Banks can just issue credit. So just loans just like you or me walking down to get a home loan or a small business loan. Large corporations can go to large banks and say, hey, I want to engage in some capital investment. Here are my books. And the bank says, okay, I'll extend you X amount of credit. This type of bank finance is still quite common in Asia and less common in the West. In the West, a lot of finance happens through bonds and stocks. So a bond is essentially an IOU. So IBM can say, hey, I'll sell you this bond that says that in a year I'll pay you $120 if you give me $100 now, right? So it's got this fixed payoff date and amount. Governments also issue bonds with the same sort of promise. This could be the federal government or local governments. Some state governments also do. A stock is different. A stock has no definite payout amount or date because it is a share of ownership of a firm. This share of ownership comes with voting rights, but it also may yield dividends because firms can essentially elect to pay all of their stockholders a share of the total profits of the firm. But there's no legal expectation for this to occur. So, stocks are also part of the market for corporate control because if an individual or a group of individuals can get a controlling share of a firm in ownership, they can essentially change personnel and policy at that firm. So, in this way, stocks have this other dimension to them that bonds do not. Also importantly, when bankruptcy proceedings occur, bondholders get paid before stockholders. So that's another aspect where bonds are a safer investment than stocks. Stocks, on average, yield a higher rate of return over time because of this additional risk. So, for the longest time, we just had firms issuing stocks and bonds, banks extending credit. But there came to be this kind of new breed of financial institution called investment banks. So they're typically associated with a commercial bank, but they do different things. They don't take deposits from individuals. They do a lot of financial services. So they facilitate initial public offerings, basically firms that are private that want to go public and sell shares of stock. They facilitate that. They facilitate bond sales. They provide consultational mergers and acquisitions to help kind of avoid running afoul of antitrust laws. And finally, they sell certain financial products. So these could be things like mortgage-backed securities or other forms of securities. They could be mutual funds, which are kind of bundles of a bunch of different stocks. So they do all of these sorts of things, but they don't take deposits and they're not really issuing credit. So most of the customers of these investment banks are large institutional investors like pension funds, mutual funds, hedge funds, and private equity firms. So in these ways, It's kind of removed from the individual level and is happening at this kind of higher institutional level. Some of the different financial products that they may sell include things like asset-backed securities. So this is just a pool of loans that generate an income stream, and they sell shares of that income stream. This is most famous in terms of mortgage-backed securities, like I talked about last week, but these loans could be anything. They could be auto loans, they could be home loans, they could be small business loans. So in that way, it doesn't really matter what they're bundling, but they're bundling them. Collateralized debt obligation, or CDO, you can think of that as another layer to the asset-backed securities. So all a CDO does is it takes an asset-backed security, it divides it up into risk levels, and sells investors shares of that income stream, but at a defined risk level. So in essence, they'll say, okay, if a bunch of people stop making their mortgage payments, and so the income flow to this that's generated by this mortgage-backed security falls, you can buy in at a higher cost tranche, and you will be paid off before people in the lower tranches. And so in this way, you kind of divvy it up, and investors are able to select their risk level. A credit default swap is simply insurance against the non-payment of a CDO. And so this kind of builds an asset stack where you've got asset-backed securities. On top of those are CDOs that are supposed to let people select the risk level they want. And then on top of that are credit default swaps, which are supposed to insure investors against downside risk. So importantly, all of these things just spread risk around. They don't eliminate it. There's still always the real present risk that individuals are just not going to make their loan payments. And so none of these different products were able to eliminate that downside risk. It just spread it around to a bunch of different individuals and institutions. And since the mortgages themselves were actually riskier than people thought, that caused a problem. So all of these financial instruments are types of derivatives. A derivative is any financial product that derives its value from other assets or outside events. It's basically a side bet on how events will unfold in the future. They can be custom or standardized and sold on exchanges. So here I got a few types. It's not super important that you know each of these, but just a forward is a promise to pay a specific price for something in the future as a buyer. A future is a standardized forward that can be sold in futures market, so it's basically a standard contract that everyone understands. An option is a right to sell something at a specific price sometime in the future, so it's kind of the opposite of a forward. A forward is something that you do as a buyer. An option is something you do as a seller. A swap is just a series of forward contracts all linked together, unfolding through time. But they can get a lot stranger than just these sorts of things. They can also just straight up be, it kind of sounds just like straight up betting, in that, for instance, there are weather futures that are weather-based derivatives that are based on, say, if a hurricane hits this city or not, it'll pay out if it does, right? And so people that operate businesses in that city that are dependent upon good weather may buy that insurance so that if the hurricane does hit, they still generate some income. Importantly, the issuer of that derivative is probably playing both sides. They're probably also issuing a counterpart derivative that pays out if it doesn't hit. And so by doing that, they can kind of ensure that they aren't paying out too much all at once. So you can write these derivatives in such a way that allows investors to assure against losses. So in essence, if I say, if I am a orange juice manufacturer, I may want to purchase an option on orange juice so that I have the right to sell it at the present price into the future. And what that basically does is it insures me against the price falling in the meantime. So in this way, derivatives are insurance, but it also lets investors double down on existing speculation, because instead of just buying an asset-backed security, you can say buy an asset-backed security and buy a derivative that is stacked atop it. So derivatives have a notional and an expected value. Notional values are what the derivative pays if events unfold in a certain way, so essentially kind of the payout. Expected value are the notional values multiplied by the probability that the events unfold in a way consistent with payout. So the expected value of derivatives is less than their notional value. And so these are all notional values rather than expected values. In 1990, there was basically no derivatives. That should be the year 2000. By the year 2000, there were $10 trillion in notional value of derivatives. And by 2011, there's $27 trillion. So it's important to note that there's no sequence of events that would cause all derivatives to pay out simultaneously, because like I said, many are kind of, if one pays out, the other will not. Because oftentimes it's one derivative says something will increase in value, or will pay out if something increases in value, and the other one will pay out if it decreases in value, right? So those two can't pay off at the same time. And it's unlikely that all conditions will be met for even a large number of derivatives to be paid out all at once. But it's still this immense speculative financial value that's sitting out there. So what are some consequences of this new financial system with this proliferation of different financial products? So one idea consistent with the efficient market hypothesis was that if we deregulate and allow finance to create all of these different instruments, it would result in them finding more efficient ways to price risk, and as a result, financial markets may become more stable. And so in this way, we can it was interpreted that the housing bubble was an efficient response to deregulation, when in fact it was probably the speculative bubble that was based on a bunch of rickety, overvalued assets. So, going along with this, the contracts that govern these kind of special purpose derivatives can be immensely complicated. So we had a large number of financial institutions that were signing complex contracts to buy financial assets, and they didn't even read the contracts because these things were hundreds and hundreds of pages long. And so they didn't fully understand the implications of what they were purchasing. There are also some implications that result from this deregulation. So there has been a great degree of financialization of non-financial firms, because these finance activities, partially in part due to this deregulation, generate a very high rate of return, something far in excess of what real investment in productive capital typically generates. So in order to kind of keep up with that rate of return to attract investment dollars, real firms have had to start engaging in a great deal of financial activity so that they can essentially attract investment dollars. So what has happened is there's been a lot more stock buybacks and dividends to generate greater rates of return for investors at the expense of long-term investment, but also these kind of firms that produce goods and services in the real economy have also begun to financialize in terms of their balance sheets. They've been engaging in a lot more investment activity, which makes them more exposed to financial risk and more exposed to the risks in the banking system generally. For instance, General Electric has a huge amount of their profits that are posted from their subsidiary, GE Capital, which is basically a finance firm. Even auto manufacturers, through their kind of internal lending programs, tend to become more financialized over time. Another consequence of the high rate of return in finance is that it generates higher salaries and thus can attract talent away from other non-financial uses. And there's also the issue of regulatory capture, where oftentimes the only people qualified that know about finance have worked for these financial firms, and so they end up regulating the firms they once worked for, or they end up working for the firms they once regulated, and both of which have their own kind of incentive problems. So let's wrap up here with this overview of financial deregulation in the U.S. Interest rate limits were really common in the early U.S. The Fed was founded in 1914, and it was not a compulsory system. Banks just simply gained access to the Fed's discount window if they kept deposits with the Fed, so they could borrow money from the Fed. And that kind of stayed the way it was, relatively unregulated for many decades. But financial regulation really started to come into force around the Great Depression because of this whole stock market bubble, right? Which there's some thought that it was also based in this real estate bubble. So the big kind of title piece of legislation of this was the Glass-Steagall Act. It created Regulation Q, which prevented banks from essentially... It put a cap on the interest rate that banks could offer people with savings accounts. So this essentially kept banks from competing with one another. It also created savings and loans organizations that were just created purely to finance mortgages, and these institutions were allowed to offer a higher interest rate than banks. Some other things that came out of the Great Depression were federal depositors insurance, and very importantly, the firewall between investment and commercial banking. I think that restates a lot in the last slide. But this firewall essentially said, regulated the different financial assets that commercial banks could hold, and it limited commercial banks to only the safest financial assets, so that commercial banks that held people's deposits were very, very stable, and investment banks, which didn't hold people's deposits, could take a little more risk. Some other things that came along in the wake of the Great Depression, just various securities acts that regulated securities in stock markets, creating regulatory bodies to oversee the savings and loans organizations, and so on. Insurance was largely just regulated by the states rather than at the federal level, so there was a pretty loose hand there, and it was very patchwork. And so this post-war regulatory structure was stable for about 40 years, but it all started kind of coming apart in the 70s. Like so many things. There was a court decision that allowed banks to extend credit across state lines. So this resulted in banks and credit card companies simply moving their headquarters to states with kind of the most permissive regulations. And this essentially ended state-level usury laws. Those kind of interest rate limits that I talked about previously. What was also happening in this time, because of stagflation, inflation was so high that deposits held in savings accounts at banks were actually losing value in real terms. So people were moving their money out of banks to money market mutual funds which had a higher rate of return and were not limited by Regulation Q. This is essentially a product offered by other sorts of financial institutions that behaved a lot like a bank account, but was exposed to more financial market risk, thus also earning a higher rate of return. In the 80s, formal interest rate limits were further phased out, FDI insurance was increased, and then the kind of optional thing where banks could keep deposits at the Fed was made mandatory. So participation in the Federal Reserve System became mandatory for federally chartered banks. So these money market mutual funds were still kind of a preferred way for people to save their money because it generated kind of greater interest rates. And the savings and loans organizations were just dying because they couldn't attract any deposits in light of these money market mutual funds. So they went to the regulators and said, hey, we need to be able to pay our depositors a higher rate of return. So they allowed them to. So higher rates were offered, and more money started flowing into the savings and loans organizations. More risky commercial investments were undertaken, and there was a housing boom and bust that really took down a huge number of these savings and loans organizations. This happened for a number of reasons. One was that there was a tax policy change that made real estate investment relatively less kind of preferable and yielded a lower rate of return. And because of that and some other factors, deposits fled from the savings and loans. And bailouts happened, a new regulatory body established, the number of savings and loans organizations were cut in half, and over $206 billion of bailouts were made in 1989. And this was the savings and loans crisis. So, in the wake of this, commercial banks were like, hey, if savings and loans can offer these high rate of returns, why can't we? And so that was kind of the phasing out of interest rates, and commercial banks were also began lobbying to gain access to higher risk and higher yielding investments. So this was like a phased deregulation. In 1986, they could have 5% of their business in these riskier assets, and it was slowly raised over time until full repeal of Glass-Steagall occurred in 1999. Because there was no longer this firewall between investment and commercial banking, there were a large series of mergers and acquisitions. Institutions became larger, and they had their fingers in a lot of different pies that were regulated by different federal entities. And kind of late 80s, early 90s, derivatives kind of began to develop in the back alleys of finance and were essentially non-regulated. Another development along this time was that active auditing by federal agencies that would send out investigators was replaced by self-reporting. So it became a lot easier to kind of hide problematic issues with your balance sheet. So securitization started taking place. We talked about that a bit in the last lecture. But banks essentially could make a bunch of loans, bundle them together, sell them off, and not have to really worry about whether the loans were repaid or not. Government-sponsored organizations like Freddie Mac and Fannie Mae bought up repackaged mortgages and sold securities, and these were considered very safe. And the ones by Fannie Mae and Freddie Mac were on kind of more secure footing. But other institutions started selling these mortgage-backed securities with riskier and riskier loans bundled up with them. Mortgage contracts were deregulated. This allowed things like teaser rates and adjustable rates that were previously not allowed. And because this kind of higher rate of return could be generated through adjustable rates, loans were extended to riskier and riskier borrowers because the expected payout was still seen as quite high. And if all else fails, banks could seize an asset that has appreciated in the meantime. So, riskier mortgages were also securitized that were a lot less safe than those offered by Fannie Mae and Freddie Mac. Simultaneous with this, there was a really low Federal Reserve interest rate, which all other interest rates in the economy are kind of linked to. This made credit very loose, and so that further kind of inflated the bubble. And it all came tumbling down when borrowers defaulted, the securities lost value, And because the banks were heavily invested and heavily leveraged in this one arena, it put them in peril and it all came tumbling down. So, the response to the crisis was very multifaceted, but there were a huge number of programs. The FDIC straight up took over failing banks. Depositors' insurance was increased, and the government guaranteed other types of debt, not just deposits. The FHFA was created to regulate Fannie Mae and Freddie Mac and other government-sponsored lending institutions. The SEC straight up banned short selling for a bit, the Securities and Exchange Commission, being the SEC. Short selling is essentially promising to deliver an asset in the future at a lower price than it currently is because you expect its price to fall in the future. So another thing the SEC did is they allowed banks to claim value on assets that had no functional market. So essentially, if you can't sell a mortgage-backed security, what's its value? Because it has no market value, right? And so the SEC allowed banks to still hold that as some value as an asset on their balance sheet. The Troubled Asset Recovery Program had the U.S. Treasury just buying up troubled companies, finance and auto companies, bailouts essentially. The Treasury also just bought a bunch of mortgage-backed securities. Meanwhile, the Fed was also buying up. It owned Bear Stearns for a while. It bought up tons of mortgage-backed securities and CDOs. Extended credit in the Fed's balance sheet grew to unimaginably large proportions compared to where it once was. This was also where quantitative easing began, where the Fed was essentially just pumping more and more money into the financial system. So, after all of these interventions, it became clear that more regulation was needed. And so a kind of new financial regulation bill was made, Dodd-Frank. It simplified the regulatory structure, eliminating and creating new agencies to kind of condense the number. Certain standards for reporting and supervision were raised, but this was mostly targeted towards large institutions that posed a systemic risk. So large institutions like AIG or Bear Stearns that, if they fail, can take the whole system with it. They were required to kind of report to a higher degree than smaller institutions. They also had to create these living wills that essentially said, well, if we do fail, here's how we'll control the failure in phased ways so it doesn't bring down the whole system with it. And this was a way to kind of for the federal government to credibly commit to not bailing those firms out in the future. Other institutions that weren't banks, like large insurance companies and hedge funds, were also brought under the regulatory umbrella of the Fed. It also created the Consumer Protections Agency, which has essentially functions to ensure that people taking out loans understand the terms of those loans. So you don't have people taking out adjustable rate mortgages believing that they have fixed rate mortgages, things like that. This stuck around for a bit, but in 2018, Dodd-Frank was rolled back to be essentially non-functional. It exempted dozens and dozens of large financial institutions, so it really kind of took the teeth out of the bill. So, that brings us up to modern day, so let's just wrap up here. Finance is really important. It helps support investment. This social function is facilitated through the profit motive, but it doesn't always work correctly because we have certain biases and their strategic concerns. Whether we're talking more or less regulation, the goal ought to be to make the financial system fulfill its social role of supporting productive investment, not just to generate profits or generate high salaries. And finally, I really like this closing thought that Chang had of maybe the introduction of a new financial product should only be allowed if we can determine that its benefits are greater than its costs and additional risks. I really like that idea, and maybe think about that for a bit. But that's all I've got for this week, and thanks. I hope there's something interesting and new there.